Today's video is sponsored by Skillshare. Now, as part of estate planning, one of the most common topics that we usually discuss with clients at the end is the concept of gift planning. Most of the time, clients are pretty generous and either they are donating regularly or they plan to leave a quite large lump sum for their favorite charity should they pass away. So what I want to do today is talk about the concept of charitable giving, going from very basic concept to much more advanced techniques on how you can more effectively give to your charity. Now, if you notice, my background changed once again. Right now, I'm done with quarantine. I'm actually in my father-in-law's office. He was very nice and he loaned me this office so I can film my YouTube videos from now on. So for the next couple of videos, you'll see me in a brand new setting and with very nice background in the back. Alright, now without further ado, let's jump into today's video. So first, let's start with the tax benefit we'll get by donating. Now in Canada, when you donate to a registered Canadian charity, you will get tax receipt. And when you file tax every year at April, you'll be able to claim donation tax credit from it. However, even though most people know they will get tax credit by donating, a lot of people actually aren't really sure how's the calculation done and what are some rules in there. Now first, understand that when you donate, you will get tax credit in return, and this is very different from tax deductible. When something is a deductible, it is taken directly off from your income and then you calculate your final tax bill. So for example, RSP is a tax deductible. Tax credit, on the other hand, directly deducts from your final tax bill. So for example, if your donation tax credit is $1,000 and your tax payable for that year is $10,000, then they would directly take $1,000 off so that at the end your tax payable is $9,000 instead. So next, let's look at how donation tax credit is actually calculated. Now for this part, it's a little bit complicated because there is the federal amount calculation and then there's the provincial, and also there's a different calculation for donation that's under $200 and donation that's above $200. So let's look at an example together. Let's look at BC for example, and on the screen I've listed a different tax rate for different amount federally, provincially, either it's above 200 or under 200. Now there is also another amount on the right hand side as you can see, but for now we're gonna ignore this and come back to it. So as you can see, federally, anything under $200 you get 15% of that as a donation credit, but any amount that's over 200, it's gonna get a 29% credit. Whereas for BC, provincially is 5.06% for anything under 200 and 16.8% for anything above 200. So let's say today someone donates $1,000. Now federally, the first $200 is gonna get a 15% tax credit, so that's gonna be $30. And provincially, we're gonna get 5.06%. For the $800 that's remaining, federally is 29% as tax credit, so $232. And for BC, provincially, 16.8% for anything that's over 200, which gives us $134. If we add up everything together, for this person, if they were to claim a full $1,000 tax credit from their donation that year, they would get $406.52 as the donation tax credit. So usually this is how the calculation will go. Now let's go back to the column that we just ignored. Basically, this is a new rule implemented in 2015, and the purpose is try to give people a better tax write-off if they're in the highest tax bracket income. Because if they're in a higher income, usually in that case, a tax deductible will actually give you a slightly better tax advantage than an actual tax credit. Now, the government, in order to combat this problem and make it attractive for very wealthy, high income people to donate again, this is why they introduced an extra tax bracket for them. To make it simple, all they're doing here is basically saying that you will get 33% of the tax credit of either the donation amount that's above $200 or whatever income that's higher than your highest tax bracket income level. Whichever is less is gonna get 33% as a tax credit. The rest will go back to the old calculation. So this sounds very confusing, but let's go over a very quick example together. So let's say 2021, to hit the highest tax bracket federally, you're gonna need $216,511. Now let's say you make 10,000 more than that, so you make 226,000-ish, and you donate 20K for 2021. Your federal tax credit looks like this on screen. First $200, like always, will get the 15% treatment. Next, it's going to be 33% of either the donation that's above $200, which in this case will be $19,800, or whatever amount is higher than the highest income level for the highest tax bracket, which for us we're 10K over. Whichever is less, we're going to get 33% of that. And since we're only 10K above the highest income level, we're going to get 33% of 10K, which is $3,300. Now the rest of the donation will get the old usual 29% calculation. Now we're going to skip the provincial side because I just want to illustrate the point here. But long story short, if you're at the highest tax bracket and you're over, federally, you are going to get a little bit better in terms of tax treatment. However, for provincial, you may or may not get it because this really depends which province you're in. So I've actually posted the donation tax credit table on the screen right here. And as you can see, only BC and Quebec have a one additional column for the highest income tax bracket, which will give people a higher donation amount. So unfortunately, at the provincial level, if you're not living in BC or Quebec, then you're not going to get a better tax treatment for your donations. Now, a couple of notes here before we move on. For donation, it can only be carried forward for 5 years. So if you're not going to use it today, you have to use it within the 5 years or you lose it. Now, second point is that donation credit can be transferred to a spouse. So you probably noticed by now that if you're not hitting the $200 limit, because anything above 200 gets a better treatment for that year in terms of donation, it's better for you to either carry forward in the future if you will keep donating, so you can actually combine them, or transfer your donation credit to your spouse or get your spouse to transfer to you. So together you can hit the 200 limit faster and then enjoy a higher tax donation credit. And lastly, usually you cannot claim too much donation in 1 year. Only 75% of your net income can be claimed as donation tax credit. Now, there is some exception for some very specific donations. And also, if you pass away that year, you can use 100% of that as a donation. But for those kind of detail, it's better you ask a CPA directly for advice. Alright, so that's the basics about donation and donation tax credit calculation. Let's move on to a more advanced technique of donating. Now, to preface, this technique is more suitable for people that have been regularly donating and they are going to donate no matter what happens in the future, or for people that have already set aside some money that they like to donate as a lump sum to their favorite charity should they pass away in the future. If you are one of these two types of people and you want to make a larger impact with your donation, then you might want to consider this technique that I'm about to talk about, which is to gift an insurance policy to your favorite charity. Now, this actually is one of the most efficient and effective tools you can use if you want to make a huge impact with your donation. So first, let's start with the easiest method of doing this, which is directly getting an insurance right now and assigning the owner and the beneficiary as a charity, while you are going to be the life insurer, plus you are going to be the person paying you the premium every year. As long as you are paying premium every year, the premium amount that you pay in this case will be counted as donation and you can get donation tax credit from it. So let's go through a real example together. Let's say today Mary lives in BC and she's 55 years old and she has already set aside a sum of $400,000 to donate to the charity upon death. Instead of waiting and donating that $400K when she passes away, instead, what she could do is actually right now go out and get a 10-year guarantee paid up insurance, and let's say each year she's paying $40K into it. Now the insurance is gonna cover for $735,000 in her case, and also it will grow in the future assuming the current dividend rate stays true. Now right away we can note a couple of things here. Number one is that death benefit that the charity will get is way more than the $400,000 that Mary has planned to set aside. Number two is that she doesn't have to wait until she passes away for her estate to enjoy that donation tax credit. If she wants to, by paying the premium every year, she's able to write that off as donation and enjoy that tax credit ahead of time. And number three is that if you take the premium that she's paying, which is about $40K, and minus the tax credit that she'll be getting back here, which is about $18K, she really is paying $22,000 in the end effectively, because $18,000 of that she get that back as tax saving. So if we compare the cost that she's paying, which is really $22,000 per year in this case, versus the lump sum that the charity can get upon her death, then that's a much more effective and efficient solution to create a bigger impact for the charity than just donating cash upon death. And finally, one thing to note is that when she stops paying for the insurance, so in this case, let's say 10 years, she's going to be paid up. Even if she wants to, she cannot pay anymore. When she stops paying the premium, she will also no longer get donation tax credit. And also another thing to consider, does she want to pay a longer time to spread out the tax credit, or she want to get it done early so that she doesn't have to worry about it by the time she reaches 65. Alright, so that was the most straightforward and easiest way of how you can use insurance to donate to charity. Next, let's look at a slightly more advanced way of doing the same thing. Now, before we move on to the more advanced technique, I want to take a quick moment to talk about our sponsor today, which is Skillshare. Skillshare is an online learning community for creatives where millions come together to take next step in their creative journey. Now, what I love about Skillshare is that it combines really well-crafted video lessons with projects, so it's not just theory. You're actually gonna be doing the work, and that's the best way to learn. Once you sign up, you have access to every single class on the website, anything from creative drawing all the way to finances and project management. For example, I'm currently learning a class called Productivity Masterclass, Create a Custom System That Works by Thomas Frank, who is also a YouTuber. Now here's the best part. Thank you for Skillshare for sponsoring this video. They're doing a promotion right now. Instead of giving you the usual 14-day trial, the first 1,000 of my subscribers to click the link in the description below will get a 1 full month free trial of Skillshare so you can start exploring your creativity today. So if you're interested, click the link below to join and check it out. Now, we're still gonna get our insurance just like before, but in this case, instead, we will be the owner here. And as for the beneficiary, it can either be the charity directly right now, or it can be going to our estate, and then we have a will stating that when we receive that death benefit, it will be donated through our estate to the charity. Now, if we do it like this, we will not be able to write off the premium every year like the last example, but in exchange, our estate will be able to claim the whole donation amount, which is the death benefit, as donation, which will give us a much bigger donation tax credit, and that can write off a lot more tax that we might face when we pass away. Now, this could be extremely useful if you're in a position where upon your death, a lot of capital gain or RSP will get triggered as a sell-off, and your family is going to face a huge tax liability for you. Then you might want to consider this kind of method. However, that's not it. It doesn't mean that once you set it up like this, you will forever be stuck and you have to wait until you pass away to use this insurance. You can actually trigger the tax credit prematurely by transferring your ownership to the charity and thus donating it to them earlier. Now, if you do something like this, there will be a couple of things that will get triggered simultaneously. Number one is that it will be treated as if you have sold the insurance. So depending on your cash value and your ACB, which is adjusted cost base, which is your book value at that time, if your cash value is too high, then you might have some capital gain that you have to handle. And secondly, it is counted as if you have donated the policy at fair market value. Now, this might be very different from the cash value that is actually inside your policy, because the true value of your policy can be greatly affected by your health, which would determine how likely or how difficult it is for you to get any more insurance in the future. The harder it is for you to get insurance in the future, the greater the value this insurance will have today. Now, usually to get the fair market value, you need a qualified actuary to calculate this for you to give you a fair assessment. However, if your policy is only been enforced for 10 years or less, then per CRA's rule, instead of using the fair market value, you're gonna have to use the ACB as the value of the policy. This is called the anti-avoidance rule. So let's go back to the same example for Mary again with the same type of insurance. Now, let's say in here she's gonna be the owner and she's gonna hold on to this insurance. But at year 7, because she foresees herself to get a massive tax bill, because let's say she's selling all her investment or her rentals, she's gonna get a huge capital gain on that year. What she could do is actually keep that policy for herself until year 7 and then make the transfer of ownership, thus making the donation. Now, doing so, her ACB is going to be $270,000, as you can see on the screen, assuming current dividend scale, which will provide her a massive tax credit for that year. Now, depending on your plan with your investment and rental properties in the future, this is something you might want to do. For example, let's say Mary in this case, if she's going to make a $40,000 premium payment every year, and she doesn't have that kind of income to write off that kind of tax, then she doesn't want to claim that premium upfront every year because she can only carry forward 5 years. But instead, she sees a huge capital gain coming at year 7, so she can hold on to it, keep paying for it, and then when the cap gain comes, she can trigger it manually and get that tax credit. Now, what happens if she passes away early? Well, it doesn't change anything. If she were to pass away before getting to transfer this ownership, then what that means is the death benefit will be paid out either to her estate and then going to the charity, or to the charity directly. Either way, her estate will be able to enjoy the massive amount of tax credit anyway to write off all the investment that she has just deemed as sold upon her death. So either way, she's going to be able to benefit from this. Now, one last interesting point about this is that let's say at year 7, her plan actually changed. She feels very financially stressed and she doesn't feel like she can pay for the last 3 years by herself. She may not necessarily have to, because most of the time for larger charities, they're actually okay for taking over the policy and then not have you to pay for it, but instead have other donors to pay for the premium, because for them it's still beneficial. As long as they can keep the insurance going, they're gonna win out in the long run. Now finally, I want to talk about one last kind of donation secret technique that you can also may find useful, and that is to do with your term insurance. So usually for term insurance, especially when it comes to renewal time, the price is going to jump significantly, and usually these kind of insurance is going to deem as useless because nobody really want to pay for this very high premium and to keep it going. But sometimes, depending on their health, this could have significant value and can help you create a lot of tax credit. So let's talk a little bit about this technique here. Now to preface, I have not tried this method myself with any of my clients. We haven't had this opportunity. However, this is something I have read on financial advisor websites, so this is why I want to talk about it. If you're CPA or you see this no longer working or there's some changes to it, make sure you let me know in the comment below. I've tried to done my research, but I couldn't find anything that is suggesting that whatever I'm saying no longer works. But if you have done it and you realize it doesn't work, let me know in the comment below. Maybe I can take this part away. So here what I'm going to do is I'm going to use the exact scenario from Advisor's Edge website to talk about how this might work. In this example, John is 71 years old. He's a non-smoker. He recently had a heart attack and he owns a term 10 policy with a 500k payout. Now, because of his heart attack, any future insurance, if he were to get it from now on, it's going to be 500% more expensive than a normal person would pay. Now, taking all these into account, the actuary is actually going to come up with a value of $225,000 for his current term 10 policy. But because we're nearing the renewal term, the renewal price is way too expensive. John cannot pay for it and does not want to keep it. Now, instead of terminating the policy in this case, what he can do is actually choose to donate this policy to the charity. If he do that and the charity accepts this kind of donation, then the market value of this policy, which is $225,000 in this case, will be counted as donation, and he can carry forward for the next 5 years to use every year to write off his tax bill. So as you can see in this case, instead of just canceling the insurance and then get nothing back and no more coverage, he can actually donate this and create more tax credit for himself in the next 5 years to write off his tax bill. However, no matter which way of the insurance donation you're thinking about using today, there are a couple of notes you need to keep in mind. Number one is you want to work with your charity and communicate with them to make sure they can accept this kind of donation. Most charity will be okay to accept this, but sometimes some charity do not accept this kind of donation. So you want to find out first. Now, number two, if you're donating an existing policy, you want to get an actuary and underwriter to work together to determine the actual value of the policy so that you get a fair assessment. And number three, no matter what, you want to have a CPA in this picture to talk about all the strategy to make sure this is actually something that is applicable and is useful for you in the coming future. But no matter what, if you're someone that's donating today or thinking about donating in the future, good on you. I myself and my wife together donate consistently, and everything I've talked about today here is also something that we're gonna be implementing in the next year into our estate planning as well. So hopefully today my video gave you more idea or better picture of how donation work and how you can set it up and plan for yourself. Now, if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to the channel. Click the bell button so you get all the notification in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!